We mentioned before that when trying to decide whether or not to dispose of a property, one issue that an investor needs to consider is the tax implications. And so let's spend a little bit of time talking about different ways that we can defer those taxes. So, one strategy would be through an installment sale. And so, in an installment sale, the buyer is making payments to the seller after the year of sale. So the seller is not going to receive all the proceeds immediately upon sale. And so in the contract for sale, it's going to stipulate all of that, what those payments are going to be and what the time frame is. So because you're not receiving all of your money at the time of sale, you're not going to incur the tax bill all at one time. Another strategy would be a tax deferred exchange. And so this is when you want to sell your property, but you want to buy something else, within a certain time frame. And so um, that allows you to carry over your basis from your existing property into the new property as long as you make that purchase within a certain time frame. And so you wouldn't have to pay the capital gains tax until you sell that new property. So a little bit more detail on the installment sale. So this is prescribed under IRS Internal Revenue Code Section 453(1). And in order for the sale to qualify, at least one of the payments that you receive has to be after the taxable year when it happened. So this is 2022. So if I'm going to have an installment sale of a property that I own, then I have to agree to receive at least one payment in 2023. And I can even finance the property for my buyer. And so it's perfectly fine for me to receive interest payments in addition to the principal because, I'm not getting my money. So yes, I'm saving on my tax bill for now, but it's okay for me to receive some interest because of that deferred transaction. So in order to qualify, the capital gain that is subject to tax each year is equal to the amount of the installment payment multiplied by the profit ratio. So my profit ratio is the gross profit divided by the contract price. Contract price is basically just the selling price minus any liabilities that the buyer is going to take over. So if they're going to assume the balance on my mortgage or anything else related to the property, that's actually income to me. So I'd have to back that out of the price in order to get to the contract price. Now, another strategy that we've talked about is the tax deferred exchange. So remember, this is the one where I can defer my capital gains tax provided that I buy another property within a specified time. So again, this is also sanctioned by the IRS, and it has to be for business or investment. And so this specific time frame where the transactions have to occur is I have to identify the property within 45 days and complete the exchange within 6 months. So this can't drag out for years and I still get to defer my capital gains. And so obviously I'm going to give up equity in my existing property and then acquire the equity in the new property. So there's a few terms that you need to understand when it comes to these exchanges. So we're getting kind of deep in the weeds in the taxes related to these property exchanges. But this, I just need you to understand kind of definition wise. So first, substitute basis. So remember we talked about basis as being your taxable base in the property. So a substitute basis is the basis in the property that new property that you're acquiring in the tax deferred exchange. So we're still under the umbrella of a tax deferred exchange. Now, if in that exchange you acquire some property that is not real property, so maybe you acquire some equipment or machinery as a part of that exchange, we call that unlike property boot. I have no idea why it's called boot, but that's what it's called. And then cash, if you receive cash. So you think about this, we're exchanging properties. Exchanging sounds like you're just giving them away, but I'm giving up my existing property. I'm acquiring a new property so that I can, well, maybe I actually want this other property and I don't want my existing property, but I'm also concerned about the tax implications. And so those properties may not be exactly identical, so we can't just swap. And so in order for me to be whole, meaning to get something equal in value to what I'm giving, that's where the boot may come in. Or it also may be that they've got the other party gives me cash, or maybe I'm giving them cash, whatever it is to make the exchange fairly equal. If there's cash received, that has to be reported as gain. Similarly, mortgage relief. So if we owe less on the property than the property that's given up, then we are considered to have received mortgage relief. So how does all this work in terms of gains and losses? So you could have an unrecognized gain, and that would be equal to your realized gain minus boot. Remember, boot is that unlike property. So you have to figure out, is this really worth it? And so is the exchange beneficial? Well, if there's less depreciation each year because of the lower basis in the second property, then that's something to take into consideration, because remember, depreciation is a non-cash expense that lowers your income and therefore lowers your taxes. So that's something to consider. And then because the gain on the exchange property has been deferred, then you could have larger capital gains when you sell that second property. So you're kind of just kicking the can down the road. So you have to be thinking about all of that as well. Now, other alternatives. So remember, this whole chapter is about what do I do with this property once I've decided that I don't think I want to own it anymore. So I could sell it. I could sell it on an installment sale if I want to not take that whole capital gain at once, or I could exchange it, or I could refinance it. And remember, we talked about maybe we refinance it so that we can get some of that equity out, diversify our portfolio. Another alternative is to renovate. So maybe I decide I don't want it anymore because in the neighborhood that it's in, I don't know, office space isn't very popular and retail space is popular. So maybe I could make improvements to the property and upgrade the quality, change the usage, and reduce the operating costs. Maybe it was just inefficient because the HVAC was old. So maybe I put some money into it, make it more efficient, lower the cost. Maybe that makes it more attractive to tenants and easier to rent. Maybe I can even get a higher rent. Um, Maybe, like I said, I could change it in a way that I could have a different economic use. Now, with renovation comes a cost. And so I have to think about, well, how am I going to pay for that? And so there may be some refinancing involved with renovation. And so how much I can get on a refinancing deal is going to depend on the value of the property once the refinancing is complete. And so I would need an appraisal for that. But if this refinancing or renovation counts as rehabilitation, there may be some tax credits that are available for that investment. And so those tax credits would reduce my tax liability, which is always a good thing. And so that's particularly true when it comes to rehabilitation of low income housing. So some of these are regional, depending on where you are, but this particular program is fairly new.